Okay, good morning, everybody, and welcome to, sorry about that. Good morning. Welcome to the Daily Energy Markets podcast. It is September 27th. It's the end, nearly, is it? Nearly the end of the third quarter. Time is flying, and the oil markets seem to be flying again. We've got Brent crude oil up this morning in Asian trade, up about 1%. Again, knocking on $95 for Brent. So the question really is, have we now completed the consolidation phase and we're back to the races? Let's go to Mukesh Sadhev, SVP, Head of Downstream Oil Trading at Rystad Energy. Mukesh, welcome back. Your thoughts on the momentum this morning in the oil markets, and have we now passed through what appeared to be a consolidation period over the last week or so, ahead of a push towards that sort of iconic number of $100 a barrel? Your thoughts?
Okay, no, thank you. Very, pleased to join this podcast.
Thank you.
I think the oil markets are in the next few months are a bit of a two phase, I would say. One is September, October, where the entire global refinery system takes a pit stop and does a lot of maintenance and turnarounds. And then in November, December, the market comes calling for more crude oil. So I guess that other than the point you mentioned about the US crude production coming higher, which might put some check on the oil prices, I believe the real impact of the cuts and the market would probably start to show up in November, December, when the refineries come out of the maintenance cycle, and then they will be looking to ask for about 2 to 3 million barrels of more crude oil. And that's where the Saudi cuts would start to pinch hard. And that's where we can see a bit more of the oil price volatility and fireworks.
Let's welcome David Fife, Chief Economist at Argus Media. David, I suppose the supply side of this story is known. There's a consensus that certainly Q4 is going to be tight, maybe some divergence on the scale of the tightness, but nonetheless, supply is being restrained. But the question on demand outlook, is the US in for a soft landing or a hard landing? Will demand sort of, plateau and ease, or will it fall off a cliff? On the demand side, your thoughts for the Q4?
Yeah, I mean, I suspect, and first of all, thanks very much for having me on the podcast. It's great to be here again. I think we're probably a little bit below consensus in terms of our expectations for demand. We see it a little bit difficult for a sort of remorseless trip towards triple-digit oil if we have this threat of an Atlantic Basin recession. And let's bear in mind that, there are lags in terms of the feed through of the impact of interest rate hikes. And therefore, we've got a demand growth level for this year of sort of 2 million barrels a day year on year. And the implication, therefore, is that the fourth quarter isn't as strong as some people are suggesting. And therefore, we see the market very well supported in the fourth quarter. We see no reason for a major collapse in prices at all. And we think Saudi Arabia and its colleagues will ensure that doesn't happen. But we find it very difficult to see a continued march higher, given the fact that we think demand is very soft in Europe, and we think will be softening over the course of the winter in the US as well.
Anish Kapadia, Director and Head of Energy at Palissy Advisors. Welcome to the podcast, Anish. Do you concur with David? I mean, we did have OPEC Plus announce their recent report of a 3 million barrel a day supply deficit in the fourth quarter. I mean, that's massive.
Yeah, I'd say I'd somewhat concur with David and go even stronger than that. When we look at the IEA numbers, they're showing around a 1.5 million barrel per day deficit in the fourth quarter. OPEC at 3 million barrels a day. We actually expect a 500,000 barrel a day oversupply in the fourth quarter of this year. So
say that again.
500,000 barrel a day oversupply of crude.
Whoa. So supply greater than demand by 500,000 barrels,
Exactly.
which is somewhat of an outlier given OPEC Plus have said a 3 million supply deficit, the IEA 1.5 million supply deficit, the EIA 300,000 barrel supply deficit, but Palissy is saying 500,000 barrels surplus on supply.
Yes, and
wow.
You know, the reason for that, it comes down to both supply and demand. We've got more bullish figures on supply. You know, we continue to see some of those sanctioned countries increasing production through the fourth quarter of this year. Venezuela,
like who? Okay, thank you. Yep.
But on the demand side, that's where we've got real concerns. You know, I think you've had some good data come out earlier this year, but I think the market is very backward looking in that. You know, concurring somewhat with David, what we see is the impact of the higher interest rates coming through. When we look at the latest data from the US, if you look at the gasoline demand data versus 2019, it's actually down over that period still. So you had quite weak comparisons versus last year, because last year you had demand destruction from very high prices. So you know, you really have to look back through the kind of COVID period to see where demand actually is, and it's weak in relative terms. So you know, we've got concerns as you're coming out of driving season on gasoline. Distillate growth hasn't been great in the first half of this year already, and we've got further concerns around that. And crucially, China, you know, we've got a lot of concerns around the Chinese data we're seeing.
Well, on that, Mukesh, we had reports overnight, profits at China's industrial firms extended double-digit drop for the first 8 months. Clearly, the macro headlines out of China this year have not delivered on the sort of year of two halves. China would bounce back after COVID. But nonetheless, Mukesh, we have seen that China's oil imports have been rather robust through the third quarter. It's near record levels. Imports are quite solid. How do you sort of separate those two things and the outlook going forward then?
No, I think I believe that there is indeed a bit of a disconnect between the macro sentiment which we hear versus the demand. Our view is that with the stimulus that's coming, with the easing of, let's say, the aviation sector visas. I just read the news today in the Australian newspaper that the visa restrictions are being removed. And jet is a big
visa restrictions on what? Sorry, Mukesh. Visa restrictions
visas, on people's tourism and travel visas is being removed right now
into Australia.
Yes, and I think same thing is happening for other countries. So our view is that you know, the jet demand or year-on-year increase about 1 million barrels. A big part of that 300 is in China, and that will most likely come through. So we maintain that despite the macro sentiment and headwinds, the demand growth in probably China is good, is decent. The only thing where things get a little bit murky is then when people compare with 21 and 2022, when China was a very high growth, bouncing back from pandemic, and those are not the right years for comparison, because China was in overdrive mode, producing the petrochemicals and plastics for rest of the world. So I think the reference point of 21, 22, and then look at 23 and say China is weak is probably wrong in my view. China is doing decent. Now, when it comes to the crude imports, a lot of refinery systems in China is coming online, and China will buy crude for these refinery systems. I would say that China is also storing and getting ready, stocking the barrels as well. We all know that the US Senate came in and banned the sale of the US barrels to China because US was draining the SPRs, the strategic advantage, well as China was building the stock. So I believe China's crude purchase is both driven by strong refinery runs, about in the order of 15 million barrels, plus their stocking of the crude oil. they have been also stocking up the products as well for the future. So I would say some future demand is playing into today's demand, and that's where the macro and the fundamentals probably disconnect. And our view is China will probably will come out more stronger than what people think.
David, I mean, it is an interesting window for chief economists of anywhere calling at the moment, which of the data points does one get guided by? You know, as you mentioned earlier, recession in the Atlantic Basin, a weaker economic outlook in the Atlantic Basin, but this is also coexisting with, you know, near full employment. I mean, which of these data points do you think determine the direction of travel going into the end of the year?
Well, I think one of the key points which we need to keep our eye on is the extent to which resurgent energy inflation ripples through the rest of the economy. Now, that's not going to happen overnight, but if you get towards the very end of the year and you're starting to see headline inflation, and indeed some feed through from energy to core inflation, causing the Fed and the ECB and the Bank of England to hike rates again, you know, we could be in the position of missing that much vaunted soft landing that everyone is looking for in terms of what the central banks can manage. As I said earlier on, I think the raising of interest rates, the tightening of monetary policy is only now beginning to feed through into the US market. The European market is looking pretty soft. Germany is essentially in recession. So, you know, I would be expecting a pretty weak fourth quarter and first quarter 24 for the Atlantic Basin. Now, of course, China and the emerging markets can help offset that, but let's not forget that, you know, interest rates and a 20-year high for the US dollar are also not helpful for emerging market demand either.
Well, on that point, Anish, the surging dollar, where do you put that into? Is it a safe haven play? Is it where the weakness of euro, Japan yen, clearly in some kind of free fall this year? Where do we assess US dollar strength, and what does it tell us?
Yeah, I think that dollar strength is, you know, somewhat a flight to safety. You know, given everything else that's happening in the wider macroeconomic spectrum, you know, but it's interesting to look at that in the context of what's happening in the US with gasoline demand as we're coming out of the summer months. If we look at the miles traveled data in the US, it's you know, it's down on a kind of 2-year basis. So the US market does look like there's cracks coming through. Still a lot of uncertainty around interest rates in the US. And you know, I think the other thing when kind of thinking about the US is, you know, are they gonna use the tool of the SPR again? If you know, if oil prices, you know,
is there anything left in the SPR to pull out?
I think you know, I think one of the other things, you know, when people look at the SPR that they get very wrong is, you know, comparing it to history. The US is now a much larger producer than it was in the past. You've got to look at it on net imports. If you look at it on the IEA criteria, they've got plenty of supply. You know, they don't need that huge strategic reserve anymore because they've got their own domestic production, which again is continuing to rise. So, you know, there's skepticism about the US using the SPR. You know, there was last time round. You know, if oil prices do kind of creep up to the $100 per barrel mark, we think the US could come out and use the SPR. And you know, similar story in China as well. If you look at China net imports, you're close to 200 days of cover for China. So you know, they build up their inventories when prices are low. If prices kind of get to that $90-$100 mark, I think you'd also see China reining back on purchases or even destocking.
On that point, Mukesh, your thoughts on where that goes with China? I mean, there are sort of reports that indicate that one of the reasons the Saudi has extended its oil supply cuts through the fourth quarter, its voluntary 1 million barrel a day, is to try and compel China to drain some of that very, very large inventory build. Your thoughts on the outlook for China digging into its inventories rather than maintaining sort of bumper imports?
Now, I think here I would point out that there is a volume story, but there is a crude quality story here as well. Because as we are coming out of pandemic globally, like jet demand needs to recover and refining system needs to make jet. But let's also remember that pre-pandemic, we were living in a pre-IMO 2020 world. Today, we want to make very low sulfur fuel, which also needs a bit of a diesel and a jet. So we have to make more jet, more diesel, more VLSFO, 4 products to be made out of the system, right? And Saudis know very well that for refineries to optimize and make all of these things in greater quantities, they need the medium sour barrels, because then refineries can do a bit of the bottom of the barrel upgradation, right? So a lot more shale oil can come, US can send the oil, but it's not the right kind of the oil which the refining system needs to make more of everything. So to me, even if there is something around to be said around the volume of the oil deficit, the quality deficit is going to stay stronger. Now, that's where I believe, which is hard to pinpoint, is that what kind of oil China has put in the storage, right? Whether it's a medium sour oil or is a light oil. I of the opinion that probably China has some unsanctioned barrels which sneak through Malaysia. We have seen a Malaysian system being used to get oils into storage. I'm sure Venezuelan oil, Iranian oil is there in the China's, in the stocks. How much they will bring out and how much they will continue to buy, I think I would not speculate on that because it's a bit of a harder thing to do. But what I do know is, as we go into the Q1, as more travel eases up, the demand sort of stays decent and strong. If we compare in the right way, China will continue to probably buy more crude oil going forward and not less crude oil from November, December period. We all talk about something called Silver September, Golden October. I sometimes get it wrong in China, but I think those 2 months are also coming in the Chinese system. So my view is that, yes, a lot of macro sentiments, recession, all these things has been there for quite some time, but the underlying reasons are still strong for the oil markets, and Saudis will not only play the volume game, but they will continue to play the quality game of cut. And in my view, this will last at least the summer of 2024. And then hopefully Saudis will believe that demand will start doing the job of keeping the oil prices high rather than the cuts and the supply cuts.
David, on the sort of move into winter and Europe, how is Europe placed for? Obviously, last year was the big drama of the Russian cutoff of gas and access to just about everything, and that progressively introduced the oil price cap, which now seems something, I don't know if it's redundant, but certainly not at the forefront of people's thoughts. Where's Europe at? Can we expect a surge in demand from European prep for winter to ensure they've got everything they need?
Well, nat gas stocks in Europe are pretty healthy. They're well above 90% fill. So I don't think there's an issue with that necessarily. And our view for nat gas over the course of the next 6 to 9 months is that the European market looks relatively well supplied. We don't envisage a major uptick in an Asian pull on LNG over the next 6 to 9 months. although demand there is relatively robust. So we think Europe is, all other things being equal, fairly well served for the winter in terms
What
of
about the Russian fuel export ban?
Yeah, well, that is a key issue, clearly. We've got diesel cracks in Europe that have recently been oscillating between $35 and $40 a barrel. Arguably, that's the sort of level that they need to be to pull in a replacement for Russian diesel. Now, obviously, if Russian diesel is shut out more broadly from the international market, then it's going to be more difficult for Europe to pull in that fuel from elsewhere. Our expectation is that the export ban from Russia is likely to be relatively short duration and has been well documented elsewhere. Part of the reason for that is that the Russians themselves have very limited product storage capacity. And therefore, they're going to have to, if they don't want to shut down their refineries and cause renewed domestic pricing problems, they're going to have to rescind the ban probably within the next 4 to 6 weeks at the most.
Let's go to the survey question, which touches on this point regarding the Atlantic Basin achieve soft or economic landing or hard. That sort of threat of the first half of the year, where everybody had anticipated and called for a hard recession, and it never came. And has that just been postponed, or has it indeed been cancelled? And a bit like the woke system, we're all being cancelled. Even the recession has been cancelled. Anish, that's obviously a very big question going into the fourth quarter for all central bank policymakers who thought they probably were done, but now facing some questions, particularly when you look at the time lag feed through from these elevated diesel and middle distillate prices. But crude, you can take it on the chin. Is 90 a lot? Is it not a lot? But certainly the middle distillates will be filtering through to all of our daily lives. Your thoughts on where central banks go in the fourth quarter and its follow through and its impact for the energy markets?
Yeah, so I think you need to look a little bit further afield in terms of the wider market. So you look at the wider markets in the US, it's been very much driven by tech, it's been driven by AI. So the market's done very well this year. If you strip all of that out, it's been a pretty weak market. And I think, again, that's somewhat what some people are missing in terms of the underlying demand that you're seeing in the economy. So, underlying demand in the US is not great. It's just being masked by the phenomenal performance you're seeing from tech stocks. I think a similar thing in Europe. If you look at, we're talking about natural gas. Natural gas demand in Europe is down sharply this year. The industrial activity hasn't recovered despite a big drop in gas prices to much more reasonable levels. So I think that there is that risk of a harder landing. You add to that inflation hasn't been taken under control in many economies. And you're going to have a further fight with rising energy prices now. So I think there's a lot of headwinds for many of the economies around the world, developing markets, but also I think the emerging markets as well. The emerging markets, China's probably 75% of global oil demand growth this year, 25% coming from the remaining emerging markets. And with the issues that we're seeing in China as well. You put all that together, it does look like you're looking towards a harder landing, certainly on the underlying data than a softer landing.
On that point, Mukesh, China and soft and hard landings, has the Chinese economy landed yet? Is this Evergrande? It seems to be this constant drip feed of headlines over the last, I don't know, 12 to 18 months now. We're a day away from the shoe dropping to be dramatic, and yet somehow they're able to manage it. Your thoughts on where the China economy has bottomed out in its challenge coming out of COVID, its challenge with these real estate developers who are, you know, it's a bit like the recession in the Atlantic Basin. It never arrives. Similarly, the kind of Armageddon predictions for the Chinese real estate construction industry never seems to arrive. Have we now passed through the worst of that?
I think so. Based on, we track a lot of real-time activity data as well in the sectors, and I think real-time aviation, real-time road transport systems, right? Yes, we had seen that the first half of the year was very good, very robust, right? So there was some contraction from the May numbers, which were very high, coming high. But at this point of time, sitting where we are, I think the stimulus package which has come, and China will continuously put more stimulus into the economy. So these counter forces, our view is that this will lead towards a more smoother recovery of the demand in the Chinese system, and China will probably, some of the restriction, the COVID-related restriction on aviation sector will go away. So our view is that probably, yes, I think those things are bottomed out, and China will come back and not grow at the much higher rate of 21 and 22 when they were producing for rest of the world, when rest of the world was in lockdown, right? Now the rest of the world has come back. So China obviously does not need to produce at that higher levels. So right reference is the way to look at China. And in that way, our view is that these stimulus packages will work, and probably China's economic system will find its way on the path to recovery versus going more down into problems.
Would that, Mukesh, just to close out that comment, would that include achieving their, you know, as they do each year, set a target for economic growth? This year, it's the Chinese government has set 5% for the growth of this year. Will that be achieved no matter what, sort of massaged or otherwise?
Well, you said the answer in your question is itself, right? Massage, right? So I think there are a lot of contradictions, I would say, sometimes in the data. One sector, things don't add up very well. So whether they will achieve the number by some contradiction is data hard for me to say. But certainly, I guess that somewhere around that number is probably their target. And if one sector of the economy, like the real estate, does not perform, I'm sure some of the other sectors, the economy will do the job, and will continue to evolve at a slower pace, but at a bit more steadier pace.
David, last word for you as we come to the end of our half hour. We're now trading into the end of the year anyway, and the markets are contracts will be rolling over and will be into sort of January, February delivery of the next cycle. So in terms of we're nearly from a trading and delivery point of view, moving into the weaker part of the year, if you like, the calendar, the 12 months in the first quarter. Have we missed the window to get to $100 oil, even if you were feeling bullish? I mean, just from the mechanics of the annual cycle, that if we haven't got there now, we won't get there because we're moving into that weaker window on a trading level.
I mean, I would say on a trend basis, you're right. We don't see the underpinnings out there being sufficiently bullish for us to get there. Now, could there be an outage, a supply disruption, a sudden sharp period of colder weather that coincides with disruptions to Russian diesel supplies? Of course, we could spike to triple-digit oil at any time, but on an underlying basis, we have prices beginning to fade as we head into the first quarter. I put on the survey that you flashed up on the screen for us what I called a soft landing, but my definition of a soft landing is one in which indeed the Atlantic Basin has 2 consecutive quarters, the fourth quarter and the first quarter, of very brief and fairly shallow contraction. And that to me is the soft landing. And that to me also seems incongruous with, on a trend basis, triple digit Brent.
Well, it's certainly, there wouldn't be the first counterintuitive thing to happen this year if indeed we even went into recession and saw $100 oil at the same time, or even full employment and recession. You know, you didn't lose your main job, but you lost the second and third job you had to work in order to pay the bills. So it is a very strange time for that sort of coexistence of different macro data, and at the same token, you know, China's having a horrible year and yet they're having record oil imports. It's all a little bit counterintuitive, and I suppose we have to expect that to continue. We will be posting our survey question on social media alongside this podcast in the next half hour, so please go there and support the retweets and so forth. Thank you so much, Anish Kapadia, for your time this morning and your insights. Mukesh Sadhav, I hope all in Australia have recovered from that humiliating beat from Wales on the weekend. Woof, 40-6. I don't think I've ever seen that. Another counterintuitive moment. Never seen that before. And of course, David in London from Argus. Thank you so much for joining us. We look forward to having you guys back soon again. Take care and have a good week. All the best.
Thank you, everyone.
Bye now. Thanks again.